Hello and welcome to Mullen's Benefits Companion. On this podcast, we provide updates and insights on employee benefit laws, regulations, and trends. I'm your host, Brydon DeWitt, and today I'm joined by Kyle Wingfield, a partner in our tax section at Mullen. Thanks for joining me on the Benefits Companion, Kyle.
Hi, Brydon. It's great to be here.
Kyle, with so many individuals and businesses recovering from the devastation of Hurricane Helene, I was hoping you could help our listeners understand some of the relief the IRS recently announced for victims of the hurricane.
Certainly. The primary relief that the IRS has offered right now is just extending the due date for various returns until May 1 of 2025. And this includes taxpayers, individuals, and businesses in the entire states of Alabama, Georgia, North Carolina, and South Carolina, and parts of Florida, Tennessee, and Virginia. And some of the returns that are extended, I'll just go through a few. It's any individual or business that has a 2024 return normally due during March or April of 2025. That's been extended again until May 1. Any individual business or tax exempt organization that has a valid extension to file their 2023 federal return. So individuals would normally be due October 15th. Now they're going to be due May 1, 2025. And importantly, though, that does not extend the time to make your payment for those returns since those predated the hurricane. Then also the 2024 quarterly estimated income tax payments normally due on January 15th, 2025, and 2025 estimated tax payments normally due on April 15th, 2025. Those again are extended to May 1 of 2025. And then quarterly payroll and excise tax returns, including, not forms 941 that are normally due on October 31, 2024, January 31 and April 30th, 2025.
Does that really apply to just people impacted by the hurricane or anyone who resides in those states?
It's anybody who resided in those states. However, at least with respect to Florida, Tennessee, and Virginia, you'll have to look a little bit more closely to see which parts of those states get the extension.
I see.
But yes, for the other states, for Alabama, Georgia, North Carolina, and South Carolina, it's for all individuals and businesses.
That's interesting. It's pretty helpful relief for those individuals impacted by Helene.
Yeah, and unfortunately, we were talking a few minutes ago, there's another storm heading this week. So who knows if that will probably, I hope all those people are safe, but, it might end up expanding the relief for the states that are covered or perhaps, additional things that the IRS can do to make it a little bit easier for those taxpayers.
Right. Yeah, and I also wanted to mention some relief under retirement plans for participants to access funds and receive some financial relief from their retirement plans. Of course, there's the standard hardship withdrawals that apply to 401k plans, 403b plans, and 457b plans. And under the 401k plan regulations, a participant can take out the amount necessary to meet an immediate and financial need where the participant does not have other resources available to them. And the circumstances for those distributions include the repair of damage to a principal residence, a payment necessary to prevent eviction from an employee's principal residence, or to pay the mortgage on their principal residence. And I can see that coming into play if someone can't work because their business has been destroyed, their employer isn't operating, and they have mortgage payments due to the bank. They can take out a hardship withdrawal from their 401k plan to pay the mortgage, pay the rent. And then under the most recent version of the 401k hardship withdrawal regulations, a new expense, which is really relevant now, are expenses incurred for an employee due to a federally declared disaster if the employee's principal residence or employment was located in the area designated by FEMA for individual assistance with respect to the disaster. So that one, that hardship withdrawal opportunity obviously is very relevant to individuals impacted by Helene. Under 457B plans, a participant can take out a hardship withdrawal only if the participant is faced with an unforeseeable emergency. Well, that's not really defined. It's based on the facts and circumstances, but I would feel pretty comfortable saying that someone impacted by Hurricane Helene or the next hurricane that's coming down the pike has suffered from an unforeseeable emergency. And in addition to that, the Secure 2.0 Act added to the code qualified disaster-related distributions. And if you remember from COVID, we had coronavirus-related distributions and we had coronavirus relief for participant loans. In the Secure 2.0 Act, Congress really just said, okay, any disaster that qualifies, we're going to apply the same relief going forward. So under Secure 2.0, a participant can take a distribution of up to $22,000 or the amount of their vested account balance. And that's from retirement plans, 401k plans, 403b plans, IRAs, 457B plans, money purchase plans. You can take this distribution due to a federally declared disaster if the participant's principal place of abode is in the disaster area. So anyone who lives in the federally declared disaster area, and if they have a retirement plan, the plan may allow them to take up to $22,000 from the plan. The taxes on that distribution is not subject to the early 10% early distribution excise tax that normally would apply. And the tax hit is taken over 3 years. So you apply the taxes over 3 years on this distribution. But if the participant repays the amount they took out to the plan within 3 years, it's treated as a tax-free rollover. So there would be no tax consequences. So basically a participant could essentially take out an interest-free, tax-free loan of up to $22,000 from their retirement account. And as long as they pay it back within 3 years, there are no tax consequences. And also, just like under the coronavirus relief, plan loans can be increased to up to $100,000 or the full vested account balance of a participant. And a plan may also allow grace on plan loan repayment. So employees impacted by the hurricane might not be able to repay their plan loans. You can give them relief, a grace period of up to 1 year, where they are not treated as in default on their plan loan for up to 1 year. They have a year to make those payments back. Now, both for the hardship distribution and the Secure Act relief, the plan document has to provide for this relief. So if your plan document does not have hardship withdrawals by the end of the plan year, so if you want to add that, if you want to add the disaster related hardship withdrawal under the general hardship provisions of a 401k plan, the plan would need to be amended for that by the end of the current plan year. For the Secure 2.0 Act relief, qualified disaster distributions, and the plan loan relief, the plan would need to be amended by December 31, 2026. So that's the deadline really for all Secure and Secure 2.0 Act provisions. So it's just important that plan administrators, it's great to provide this relief, but if you do provide it, you need to know what you provided and when, and then make sure that the plan is amended on time to accommodate these changes in plan administration. But it's just a way for people who are impacted by the hurricane to access some retirement funds they wouldn't otherwise be able to access, and to kind of weather the storm, literally weather the storm. So Kyle, thank you again for joining me on the Benefits Companion.
Yeah, great to be here. Thank you.
Thank you so much. And that'll wrap up our discussion. If listeners have any questions or suggestions for future episodes, please contact me. You can also visit our employee benefits page at williamsmullen.com/employee benefits. There you can find out more about our team, as well as past episodes of this podcast and legal alerts. And finally, be sure to subscribe to this podcast to be notified when our next episode posts. Thanks for listening.